Warren Buffett is worth over $100 billion, and he still lives in the same modest house he bought 1958 for $31,000. He eats McDonald's breakfast, drinks cheap cola, and has given away most of his fortune. For the richest investor who ever lived, he is almost aggressively normal, and that is not a quirk. It's the whole philosophy. Buffett got rich not through genius trades or secret information, but by understanding a handful of simple principles about money and human behavior, and then following them with almost inhuman discipline for 80 years. He says it himself, you don't need to be brilliant to build wealth, you need to be rational, patient, and able to control your own emotions while everyone around you loses theirs. Today I'm taking Buffett's core rules, the ones that apply to a normal person with a normal income, not just billionaires, and breaking them down in plain language. Number 4 is the one he says is the real reason most people fail with money, and it has nothing to do with intelligence. One quick thing before we start. This isn't stock tips, and it isn't about becoming an investor overnight. Buffett's real genius was never picking stocks, it was temperament, the way he thinks about money, risk, and patience. And that temperament is completely learnable, and it applies whether you're investing a fortune or your first $100. That's what we're after, how the greatest money mind alive actually thinks. Let's get into it. Rule 1. Don't lose money. Rule 1. The first rule is don't lose money, and the second rule is never forget the first rule. This is Buffett's most famous line, and people laugh at it because it sounds obvious until they understand what he actually means. He's not saying never take any risk. He's saying that protecting what you have matters more than chasing exciting gains because losses hurt you far more than equal gains help you. Buffett is obsessed with the downside first, always asking not, how much could I make, but how much could I lose, and refusing deals where the answer is everything. Here's the mechanism, and it's mathematical, not just cautious. Losses are asymmetric. If you lose 50% of your money, you don't need a 50% gain to recover. You need a 100% gain just to get back to even. A big loss doesn't set you back a little. It sets you back years because it destroys the base that compounding was going to grow. This is why Buffett walks away from the exciting, risky, too good to be true opportunities that tempt everyone else. He knows a single catastrophic loss can undo decades of patient building, and that avoiding ruin is more than half the game. The move. Before any money decision, ask Buffett's first question, what's the worst that can happen here, and can I survive it? Protect your downside before you dream about your upside. You cannot compound money you've lost, and staying in the game beats any single swing for the fences. Rule 2. Let the snowball roll. Rule 2. Get compounding working early, and then do the hardest thing, leave it completely alone. Buffett made 99% of his wealth after his 50th birthday. Read that again. The richest investor alive built almost his entire fortune in the second half of his life. Because that's how compounding works. It's quiet and unimpressive for decades, and then it explodes. He calls it a snowball. You start with a small ball at the top of a very long hill, and the magic isn't the ball. It's the length of the hill and the fact that you never stop it rolling. Here's the mechanism, and it's the single idea Buffett credits most. Money that compounds grows on itself, and then that growth grows too, so the curve starts nearly flat and then bends sharply upward at the end. Which means the two things that matter most are starting early to lengthen the hill and never interrupting it, because every time you stop the snowball, sell in a panic, pull the money out, spend the gains, you reset the most powerful part of the process. Buffett's near-magical results come less from picking better than everyone, and more from simply never interrupting a good thing for 60 straight years. Most people can't sit still that long, and that impatience is exactly what costs them the fortune. The move. Start compounding as early as you possibly can, even small, and then treat it like a snowball you refuse to stop. Don't panic sell, don't cash out, don't interrupt it. The money isn't made in the buying or the selling. It's made in the waiting. Rule 3. Stay in your circle. Rule 3. Invest only in what you actually understand and know the edges of your own knowledge. Buffett has a concept he calls the circle of competence, the set of things you genuinely understand. And his rule is simple: stay inside it. He famously avoided the entire dot-com boom because he didn't understand those businesses, and everyone called him a dinosaur right up until the bubble burst and wiped out the people who'd mocked him. His point is not that the circle has to be big. It's that you have to know where its edges are and have the humility to not step outside them, chasing something you don't actually understand. Here's the mechanism. Most financial disasters come from people putting money into things they don't understand because someone promised big returns, the hot investment, the trendy coin, the can't-lose opportunity a friend swears by. Not understanding it means you can't tell a real opportunity from a trap, you can't judge the risk, and you can't hold steady when it drops because you never knew why you were in it. Buffett would rather miss 100 exciting things he doesn't understand than lose money on one, because inside your circle you can actually think, and outside it you're just gambling with extra steps. The size of your circle doesn't determine your success. Knowing its boundaries does. The move. Only put money into things you genuinely understand, and be honest about where your understanding ends. It's fine to have a small circle. Everyone does. It is not fine to pretend it's bigger than it is, because that pretending is where people lose everything. Rule 4. Master your emotions. Rule 4. The real reason people fail. Control your temperament, because investing is not about IQ, it's about emotional control. Buffett says something that surprises people, that success in building wealth has almost nothing to do with intelligence and almost everything to do with temperament. He puts it bluntly, that you don't need a high IQ, you need the emotional discipline to not do the stupid thing when everyone around you is doing it. His most famous instruction captures it: be fearful when others are greedy, and greedy when others are fearful. In other words, the entire game often comes down to doing the opposite of the crowd's panic. Here's the mechanism, and it's pure psychology. Markets and money move in waves of collective emotion. Everyone gets greedy and piles in at the top. Everyone gets terrified and sells at the bottom. And the average person, swept up in the crowd's feelings, buys high and sells low, the exact opposite of what builds wealth. Buffett's edge was never a better brain. It was a steadier stomach, the ability to stay rational and calm precisely when everyone else was losing their heads. When there's blood in the streets and everyone's panic selling, he's buying. When everyone's euphoric and greedy, he's cautious. He's not smarter than the crowd. He's just not ruled by the same fear and greed. And over a lifetime, that emotional control is worth more than any amount of raw intelligence. The move. Decide in advance that you will not follow the crowd's panic or its greed. When everyone's terrified, that's usually the worst time to sell. When everyone's euphoric, that's usually the time for caution. Master your own emotions, and you beat people far smarter than you. Rule 5. Live below your means. Rule 5. Spend far less than you can, because wealth is what you keep and grow, not what you show. For a man worth $100 billion, Buffett's personal life is almost comically frugal. The same old house, the cheap breakfast, the modest car, no yacht, no showing off. And it's not an act, it's a principle he's held since he was a broke young man saving every dollar he could to feed his snowball. He understood early that money spent on show is money taken away from compounding, and that the point was never to look rich, it was to become and stay genuinely wealthy. Here's the mechanism, and it's the same one under every wealth philosophy, but Buffett lived it to an extreme. Every dollar you don't spend is a dollar that can be invested, and every dollar invested young becomes many dollars later. So spending on status is doubly expensive. You lose the dollar now, and you lose everything that dollar would have compounded into over the following decades. Buffett looked at a fancy purchase and instinctively saw not the price tag, but what that money would grow into if left to compound, and almost always, the future amount made the purchase look absurd. He didn't stay frugal because he was cheap. He stayed frugal because he could see, more clearly than anyone, the enormous future cost of present spending. The move. Judge purchases the way Buffett does, not by the price today, but by what that money could become if invested for decades. Live well below what you could afford, not out of deprivation, but because you can see what those dollars are really worth. The wealthiest investor alive kept the small house on purpose. Rule 6. Time beats timing. Rule 6. It's about time in the game, not timing the game, so stop trying to be clever. Buffett is relentless on this, that trying to time the market to jump in and out at the perfect moments is a fool's errand that even the professionals fail at, and that the ordinary person is far better served by simply buying steadily and holding for the long run. He said the average person should mostly just consistently buy a low-cost fund that owns a broad slice of the whole market, and then hold it through everything, the crashes, the booms, the scary headlines, for decades. Not clever? Not exciting, just relentlessly consistent. Here's the mechanism, and it's humbling. Almost nobody, including the experts, can reliably predict the short-term ups and downs of markets, and the people who try mostly hurt themselves, selling before rebounds, buying before drops, paying fees, and missing the handful of big up days that produce most of the long-term gains. Meanwhile, the person who does the boring thing, buys consistently, holds through the storms, and never tries to be clever, captures the long upward march that the market has always eventually made. Buffett's advice to ordinary people is almost anticlimactic. Don't try to be a genius. Just keep buying and keep holding, because time in the market beats timing the market nearly every time for nearly everyone. The move. Stop trying to time your entries and exits perfectly, you'll lose. Buy consistently, hold through the fear, and let the years do the work. The boring, patient approach quietly beats the clever one, and Buffett, the smartest of them all, is the one telling you so. Rule 7. Invest in yourself. Rule 7. The best investment you can make is in yourself, and it's the one that can never be taken away. Ask Buffett for the single best investment a person can make, and he doesn't name a stock. He says invest in yourself, your skills, your knowledge, your ability to communicate and think. Because that's the one asset no market crash, no inflation, no tax, and no bad luck can ever take from you. He said that anything you do to improve your own talents and value is worth far more than any financial investment, because you get all of the return. It compounds for your entire life, and it's completely protected from every external force that threatens ordinary money. Here's the mechanism, and it ties the whole philosophy together. Every other rule is about managing money you already have, but this one is about the engine that produces the money in the first place, you. Improve your skills and your value, and you earn more, which means more to save, protect, and compound. So investing in yourself multiplies the power of every other rule. And unlike a stock, your improved abilities can't drop 50% in a crash, can't be inflated away, can't be seized. They stay with you through everything, paying returns for the rest of your life. Buffett, who could invest in literally anything on earth, says the highest returning asset available to you is the one you're already carrying around, and almost nobody funds it enough. The move. Put real time and money into becoming more capable. Skills, knowledge, how you think and communicate, because it's the one investment guaranteed to pay off and impossible to lose. The greatest investor alive says it's the best there is, and it's fully available to you right now regardless of your balance. The turn, steady, not brilliant. So look at the 7 together, because they reveal something surprising about the greatest investor who ever lived. Don't lose money. Let compounding run. Stay in your circle. Master your emotions. Live below your means. Choose time over timing. Invest in yourself. There's not one exotic strategy in that list, not one secret, not one thing requiring genius. Buffett's entire edge, by his own account, is that he's rational when others are emotional, patient when others are rushed, and disciplined enough to actually follow simple rules for 80 years without breaking. He didn't win by being the smartest person in the room. He won by being the steadiest for the longest. And that's the whole spirit of this channel, laid bare in the richest possible example. Real wealth was never about being brilliant or getting lucky or finding a secret. It's about understanding a few simple, boring, powerful truths, and then having the temperament to live them calmly, patiently, while everyone around you chases excitement and gets burned. The most successful investor in history lives in a modest house and tells you the answer is discipline, not genius. Maybe it's time we believed him. So here's your move. And don't try to become Warren Buffett by Friday. Remember, his real skill was patience, not speed. Pick the one rule that exposed something in you, the losses, the emotions, the spending, the impatience, and start practicing just that one. Protect your downside once. Stay calm through one dip. Invest in yourself this week. That's how the temperament actually gets built, one rational choice at a time, repeated for years. And if this is the kind of grounded breakdown you want more of, subscribe to Rich Person Habits, because every week I take one more timeless idea about building real wealth and I show you exactly how it works. No hype, no shortcuts, just what actually works. I'll see you in the next one.